And I can see many corporates over here, members from corporates, which are very new face for all of us. Friends, now the second session, which is a panel discussion. And I would request Sanjay Majmudar sir, Drushti Desai sir, and Chinmay Naik sir to join us, and requesting Vikas sir and Silpang bhai to escort the faculties. CA Sanjay Majmudar sir is a rank holder in academics and having experience of more than 37 years. He is an academician and lectured at various colleges and forums, and even a writer. His main area of practice is project finance, public issue, private equity, merger and acquisition, and he is also a professional director on the board of various listed companies. Thank you. I request Anjali ma'am to please appreciate with a memento to sir. Ms. Drushti Desai, as CA, with more than 26 years of experience, is a partner at Bansi S. Mehta and Company, and her area of practice includes corporate advisory, merger and acquisition, advisory and valuations, direct tax advisory, succession planning, and many more. She is also an independent director on the boards of several listed and unlisted companies, and even she was the vice chairperson of WIRC in the year 2021-22. I request Anjali ma'am to please felicitate ma'am. Mr. Chinmay Naik, he is a partner for transaction advisory of KC Mehta and Company LLP, and having experience of more than 12 years in transaction advisory and assurance services working with Indian as well as global consulting firm. He is having an experience of advisory roles including financial and commercial due diligence, vendor assistance, business plan and feasibility reviews, and many more. He is a regular speaker and a guest lecturer on corporate finance at various forums. He regularly contributes to various thought leadership publications at KC Mehta and Company LLP. I request CA Vikas Jain sir to please facilitate Chinmay sir. Now I request Silpang bhai, Karya to please take on the session.
Good morning, participants, and welcome to this second session of this full-day seminar on M&A. So we have all eminent personality today with us, and the topic of this second session is basically on the due diligence, valuations, and risk assessment. So we know the M&A transaction is increasing day by day. So during the first half of the 2023, there are, I think, transaction has crossed more than 1,400. And the need of professionals who can cater these due diligence and valuations is increasing day by day. So it's not only that only the big four or big firms can handle this activity. So our professional firms has to match who are interested in these activities, and we have eminent personality. So we will have their views and their expertise, and we will take their insight on the subject. Sanjay ji. So, yes. Just I want to ask one thing. Since yourself is in the field of M&A activity since number of years, so kindly highlight how the M&A activity has moved from 2 decades to till now in terms of the number of transactions, in terms of the purpose of the transactions. So how the corporates are moving towards the M&A. So you please just briefly highlight before we comment on exactly on the topic. Mm-hmm.
Well, thank you, Silpang bhai. Just as a very opening remark, in last 2 decades, the world has changed about 20 times. I mean, if you see the comparison, I don't have the exact details of what was the situation before 20 years, but if you ask me today, M&A has become a very normal process. I think in the previous session, Mr. Bora must have highlighted the purpose, synergies, etc. But most important, it is inorganic growth, it is competition elimination. There are many, many factors. If you look at inbound acquisitions that are happening in India, we have seen a very remarkable change over the last 10 years that a lot of SMEs are also now becoming targets. Earlier we used to, talk about very large, big ticket acquisitions happening. And if you look at the banks or the advisors, we all know that banks like Goldman, JP Morgan, Morgan Stanley, Citi, Deutsche, Rothschild, these are very, very large banks who have been doing very large, big ticket acquisitions. But when it comes to mid-sized transactions, I think transaction size is ranging from about, I'm talking of enterprise value, that is at the value at which the transaction is,
Yes.
valued.
Yes.
Between 100 to about 1,000 to 1,500 crores has gone up significantly. And to my mind, if we look at this audience and what we are involved, I think these are the tickets where people like us or people who are chartered accountants, advisors have a very big role to play. In terms of some statistics, I think 21-22 numbers broadly, globally the M&A deal size was almost 6 trillion, 5.9 to 6 trillion dollars. Before 20 years, this could be $6 billion. I mean, this is the scale at which the whole world has changed. Mr. Vora discussed in the previous session that, there are marketplaces. You want to enter a market. You want to eliminate competition. You want to do an inorganic growth. Another very big change I have seen over the last 10 years is that Indian companies have become also aggressive in cross-border acquisitions as well as inbound. I mean, within the country, a lot of acquisitions are happening. Now, as we all know, when there is an acquisition, it is very obvious that some synergies are given. Many times, as he was explaining, this is crazy valuations. It's a valuation game. And there it doesn't make sense, honestly. But in the hindsight, many times acquisitions could succeed, many times they would fail. But very important, if I talk of our relevance, our fraternity, I think right from the basic synergy study, that why a particular deal, and I would personally feel that lot of inbound acquisitions of our target clients who are SME or medium-sized companies, I think we have a very large role to play. One, we have to handhold the promoter in the process. He doesn't know what is going to happen. Because if we are the target, then the acquirers are fully equipped. They have an M&A team. Then they have a battery of advisors who would do the valuation, comparable company multiples, L9 and number of times sales, whatever are the yardsticks if it is a market acquisition game. But whether that valuation is okay, what is the deal structure, do I dilute a majority, or what is it that I can stand, how could the transaction documents, the non-binding term sheet, the transaction documents, the entire due diligence process. The problem is the due diligence is done by very, very solid Big Four or equivalent firms whenever the acquirer is overseas or a large company, and our clients are not equipped. They don't even know how to face that due diligence. So advising them, helping them, hand-holding them, creating the entire ecosystem which is plausible and understandable to them is a very important role that I have seen that is evolving for the young generation, the young chartered accountants. So this is and multiple, so it would be industrials, it would be financials, consumer durables, insurance, banking, all sorts. And then of course, you will not know these people are experts. The due diligence questionnaires are mind-blowing. You will not even, I have seen clients, they will know that Sanjay bhai, aisa koi law hai which I have to comply. So there are multiple non-compliances, multiple small issues, because it's a very simple trick. Make a client agree to a valuation, do a very tight due diligence, do a due diligence adjustment, and reduce the valuation. So it's a cycle. Once you are in it, it is 3-4 months. Then the client will find it very difficult to backtrack. And there I think we have a very important role. Yes. Then all the transaction documents. A share purchase agreement, shareholders agreement.
Many things.
Many. So if there is a technology license, there will be a license. There are so many clauses. They are armed with large lawyers. Our clients, most of the SME clients cannot afford very big ticket lawyer or very big ticket advisory firm. And this is where I see a role, very important. It's a very changing scenario.
Thank you.
Yeah.
Drushti ji, I wanted to ask you, that generally valuation is closed before the non-binding agreement, or it is basically tentative valuation and the final valuation is closed only after the due diligence process. And before, if broadly valuation is carried out before the non-binding agreement, and thereafter if valuation is closed, so what would be the majorly, what's the change in your opinion?
So let's just touch upon the process, which one follows. So first thing, you make a pitch deck. The buyers and the sellers, they come together and they understand the business. So there are several buyers who would be in the market. The seller wants to have that investor. So there's some basic financial information about the USP of the product. Several things will be mentioned in that pitch deck. So once that is floated, based on that, there will have to be certain assumption-based valuation which the buyer will have to put up to the seller. Now this is a very, very tentative valuation. I won't say at all that this has to be, something which has to be, binding. And that's the reason why people sign this NBA, non-binding offer, NBO, basically. That is the time after that is signed that the due diligence process starts. Now, if there is no offer on the table and if somebody just wants information about the seller, then he will give some peanut value and then of course the seller is not interested in giving his information. So the due diligence process just cannot start. So it is very important to have some value to start off with and then the due diligence process should start.
Role of the valuer firm comes pre non-binding agreement and post due diligence also. Both time we need to carry out the valuations.
So when you are working as an advisor, yes, the role of the valuer comes in even before the non-binding agreement and post. Because post is because once the diligence is done, then there are so many areas of CPs and so many things which will be found: inventory, debtors, turnover. In fact, there are many times when you find that the turnover itself is something where there have to be certain adjustments which have to be made because the accounting standards are used in a different way. So there is an impact on profit, there is impact on turnover. So there will be some liabilities that will come up through the diligence process. All these adjustments will have to be factored in the final value.
So can you highlight certain case? Suppose pre due diligence the valuation was 100, and after due diligence, what could be the broadly change? It could be 20% down, 30%, or it can be as it is. As you please share your experience.
So it all depends. Ideally, if somebody is serious, the seller is very serious about selling, and he should know that he should not pitch a price which is not really acceptable. So I would say that very frankly, if the delta is more than 25%, it is possible that the seller also will say that I am not interested in going ahead. And since it is a non-binding, offer, so obviously then the deal will not go through.
Okay, thank you. If participant has any question, it can be covered right now or later on.
You can make it interactive.
Okay. If any participant has a question with regard to this specific question, they can ask right now also. Okay, Chinmay bhai. Okay. Can you please highlight the entire due diligence process and objectives? Which are the objectives to be achieved through due diligence? And whether objectives are similar in all kind of M&A, or promoter defines the objective that I want to achieve this objective only through due diligence process?
Sure. So I think to start with, first of all, there is a lot of misconception about the term and the process due diligence as itself. Like Sanjay bhai rightly pointed out, people feel fear that, a due diligence is going to happen. What in the world is going to happen with me? Frankly, the best part and the worst part about due diligence is it is not guided by any standards or any principles. Why the best part is, like you Shilpang bhai rightly pointed out, it all depends upon the two parties, the buyer, seller, and the investor, investee. Right? What are the synergies? What are the expectations? What is the rationale out of a deal? So that will drive the scope of due diligence, number one. Why the worst part of it, or the not so good part about it is, people then start thinking that due diligence includes everything under the sun. right? And that is where the real challenge comes for us as advisors, because how to scope out a due diligence exercise in that sense. So I think the way it goes is, first of all, of course, while two parties come together, they have a rationale, they have some sort of a structure in mind, they have the synergies in mind, what they really want out of the deal. Based on that, the due diligence advisors are appointed, their scope is decided. When we talk about due diligence, it's not just restricted to financial or tax. It will also cover legal, it will cover secretarial, it will cover technical aspects as well. For technology companies, technical aspects becomes all the more relevant. For IT and services companies, the human resources aspect is equally important, because that's the only resource that you have. So in such cases, an HRDD also becomes equally important to be performed. As a process, roughly the way it goes is, first of all, of course, you decide the scope, right? You as in the advisor sits across the table with the buyer, with the seller, or with the investor-investee to decide what the scope of due diligence is. What all do you want to really want us to cover as a part of it? So it can include your historical financials, which definitely is in all cases. Then when we talk about the historical financials, we also have the tax aspects coming alongside. It will of course include your direct taxes, indirect taxes. Then many of the times your valuation is based upon an income approach or the VCF approach. So in such a case, validation, while of course forecasts cannot be really validated, but they can always be reasoned out, right? So for that purpose, the commercial due diligence generally takes place, wherein a lot of question answer session happens with the management, with the target, to understand why those projections were given in the way they were given, right? What is the real market size? What is your market share? Where do you want to really go a few years down the line? And yes, what you are saying, whether it is really getting justified by way of the ground reality or not. So yes, one is the historical part, which we generally call the financial due diligence, very much akin to audit, which also covers your direct tax aspects, indirect tax aspects. Legal due diligence, the most expensive as well as the extensive one, as I may put it, is because everything under the sun, when you say law, there are plethora of laws applicable in India. Right? So extremely lengthy as a process, which is legal due diligence generally done by law firms. So for that, each and every law under the sun would actually start becoming applicable to, like Sanjay rightly pointed out, a lot of us do not know at times that such a law is even in existence, right? And such questions really come from law firms in terms of understanding, what basically that law or that particular act pertains to. So again, as a process, first of all, the scoping happens. Then based upon the scoping, a requirement list or a checklist is kind of drawn out and shared with the target company or the investee company in terms of the data readiness. Then data room is set up. The data room can be physical data room. Nowadays, of course, it's more like a virtual data room, wherein all the documents are kept in soft copies, uploaded on a virtual data room through a secured server, and the information exchange happens with the due diligence advisors. So the checklist then comes. Then of course, the advisors start receiving the information. Then the review of information happens. Based on that, whatever your queries, doubts, etc. is there, and extensive Q&A sessions happen with the management, with the target, in terms of understanding the observations, the findings, the issues that may have come in, or the gaps that may be there. And post that, of course, a reporting happens. Again, because it is not guided by specific standards, we don't have a standard report like we generally see in case of audit or a tax audit, etc. So here, again, the reporting is guided by what are the expectations of the buyer, right? And why and how it is important to keep it crisp. Because at the end of the day, again, the buyer or the investor would not want to have a 100, 200-pager report which does not serve the purpose, right? So, and of course, we don't like seeing what we already know, right? So, rather, the focus of due diligence advisors should be on reporting aspects on an exception or a red flags basis, which really impact the rationale of the deal, which was established at the time when the scoping was taking place of due diligence. And yes, of course, once the reporting happens, then goes the stage towards negotiations, valuation adjustments at times. If the findings are grave enough, it may even lead to impact on the transaction documents. It would lead to getting indemnities. It could lead to an escrow mechanism, deferment, structure may change, right? So those aspects then generally follow post this exercise.
You just referred that projection validation is also carried out through due diligence. So whether it comes under the scope of valuation professional or under the scope of due diligence party?
ideally we would want to keep a Chinese wall over here, right? Because if I am the person who is valuing, how can I diligence my own work, right? While yes, I may certainly have the capabilities of doing it, but we would generally expect two separate advisors working around this.
You can also share the view.
I just want to pitch in here. Basically, whenever we do a valuation, it is not about just putting some formula and just mindlessly doing something. Valuers are asked whether they have looked at the numbers, whether they have validated the numbers, are they accepting what projections have been given. So it has always been the case with valuers that we look at the projections, we run our processes, see the ratios, see the past, see the market movement, the market developments, economy, everything, and then validate the projections. Only after that we accept it in our valuation. Although we say we have not really gone into or vetted the projection because that is not our role. But without that, to accept is absolutely impossible.
Even valuer also needs to carry out the due diligence. So we can say their due diligence being carried out by the two parties.
On the numbers, so due diligence process as just enlisted, that is very different. And on the numbers and on the projections, the due diligence that is carried out by valuers is very different. It's a very different process.
It's very rightly said. I mean, if I can take that liberty of making it a little internally also interactive to make it a little more interesting. So as Drushti explained, it's very important to understand that there are 2-3 different approaches. Whatever you may do a valuation, it is always a discovery game. The buyer may not just want to even look at your valuation. Because if the buyer is strategic, he understands your business. So there are 2-3 processes. One is, for example, if I have a client who wants us to help in arriving at a fair valuation and then run a process for identifying buyers, it's a completely different ballgame. There is a concept of VDD, vendor due diligence. So if I am a company with 1,000, 2,000 crore turnover, 100, 200 crore profit, I am expecting a deal of say 5,000, 7,000 crore. I would want to make sure that, as she said, I will try to arrive at a valuation which is roughly your positioning in the industry, comparable companies, who are your peers, what is it that you have to expect in terms of a multiple, in terms of whatever sales multiple, EBITDA multiple. Now, a valuer may have his own concept, but it is for the company to understand that yes, this is a reasonable expectation. Then I run a process, I approach a banker. A banker may then try to scout for potential buyers. And there the VDD, if I have done a vendor due diligence myself, that document is ready, then virtual data room, that whole interaction becomes much easier. It is very much possible that the buyer may have his own concept of valuation. He will probably, it's an intense negotiation. So a valuation is not a gospel. It may work, may not work. It just gives you an indication that yes, this is the range. Ultimately, it's a judgmental call. And then non-binding term sheet ke pehle, all this exercise definitely happens. And then only a bid, which is NB, non-binding offer, happens. A bid cannot be loose. Because if it's a process and it's a loose bid, it is liable to be rejected. So, lot of, I would say, application of mind and interaction happens. Then the term sheet gets signed. Then the due diligence adjustments. If due diligence adjustments are remarkable, that means your own documentation was poor, and therefore then the deal probably may not go through. So it's a very interactive and intensely engaging process.
Understand.
It's not just a report and a formula, and it doesn't happen that.
Yes, 100%. Madam, generally promoter gives the tentative valuation before they give the assignment of the valuation, or you take the independent call only on the valuations?
It all depends on how equipped is the promoter. Sometimes the promoter doesn't have any idea about his own value also. And they actually look at business in a very different way, and we valuers look at it very differently. So sometimes promoters require valuers to guide them on what should be the value that should be paid. But of course, we have to also look at the promoter's angle, look at the payback, because payback is what really hits them. You know, that is what appeals to them maximum when we come to a promoter, perspective.
And then the advisor would be guiding on valuation.
Absolutely.
The banker, he would know.
Yes, yes, definitely. Sanjay bhai, before carrying out the due diligence, definitely NDA is carried out. So if after after the closing of the due diligence process and if deal doesn't materialize, so whether NDA protects the interest of the party?
Sure. So, of course, it's a very serious commitment, and then many cases, if there is a competition, it becomes a very critical document, because if a competitor is acquiring another
Yes.
relatively in the same field,
They may
then
use this tool.
100%. Now, many times I have seen many transactions that if there are intensely competing companies, then NDAs won't work. So how much data, you know how the process runs. Say, for example, I'm running a process that one client is getting superannuated and he says, my son is not interested and I want to sell the business, find a good buyer. He's obviously interested, then he will say that I want to still continue for 2-3 years, etc., etc. He will ready to sell a majority, but he has his own time frame and his window and his expectation, his wish lists. So the first part is that nobody wants to go to the market and say, I'm up for sale. So there is a teaser which is prepared where on a no-name basis, if they want to run a process, most of the time a banker would be appointed. And the banker has a network. For example, these days, unbelievable networks are available where, worldwide, in that particular industry, who could be the leading players, who could be interested, all those data is available, based on which the advisor will say that let's approach A company in Germany, B company in USA, C company in Japan. Now that is available based on the information. Once that happens, teaser is circulated. If the targeted buyer feels interested, he will be then signing an NDA. He will not get further information unless he signs an NDA. NDA is also these days a very complicated document. If it is a cross-border, typically we define jurisdiction, we define confidentiality, we say there is an arbitration clause, we say arbitral tribunal of Singapore or something. So, you cannot take that document, and then there are exclusions in the NDA that whatever information, for example, if I am a public limited company, a lot of information is anyway available in public domain. So all that is excluded. But so what is it that I want to share? Now let me come to the second stage. Say my competitor signs an NDA, I know yaar ye mera competition hai. So what I'll do, the next stage is preparing an IM where we have a right not to share certain information, but I will say that client, company A, B, C, D, E, my customer A, customer B, customer C, one is 20%, one is 30%, over last 5 years, this is the sales, this is how it has happened, my product A, B, C, my geography 1, 2, 3. I can, without naming all that, I can give him the IM, so that my data is protected. Supposing he doesn't want to do the deal, I don't want to reveal everything at this stage. Then he will give me a NBO. In the NBO, it is a detailed NBO. I would want to know how you're going to fund the transaction, what is the structure, what is the percentage you want to acquire, what is your synergy, why do you see that I am a good acquisition, and what is the valuation. If I agree on all these parameters, then only I will accept the NBO and I'll sign it. Then the due diligence will start. So only during the due deal process, all the confidential information will actually get revealed. So this is a very, very sacrosanct process, and we have to make sure that, the client, otherwise you're right, he is exposing himself, that man will walk away.
Yes.
There is no compulsion. As he said, ऐसा कोई accounting जो कोई standard नहीं है. It's a buyer and a seller. If I want to buy, I'll buy, otherwise I'll not buy. And therefore you have to do this process very, very carefully.
Understand.
So if I may just add, I think even at times, when two competitors are really looking at each other in terms of doing some sort of a joint venture or acquisition, we prefer doing masking, what sir rightly mentioned. Even at the due diligence stage, the data that is shared, all the customer names, supplier names, employee names are masked. let's say, by way of customer ABC, etc., or customer 123, supplier 123, etc. Similarly, employee names are not disclosed, only the employee codes are disclosed. When we share agreements with them, extensive redaction of those agreements happens first before sharing or uploading it onto the virtual data room. In fact, a lot of VDR service providers do give us this functionality of redacting it online as well. You just need to enter the keywords, the supplier name, and the entire redaction will happen by way of the AI tool that they have. So the confidentiality can still be maintained even at the due diligence stage, which of course only once the signing happens or the final definitive agreements are decided, only at that point of time the entire details are then fully disclosed to the other side. So we have seen such things also.
Whether any legal litigation is happened only on the basis of the NDA? Of course. Okay. So what could be the volume of that?
We don't have those statistics. They are not published. But if any confidential breach is happening, and particularly, mind you, all the cross-border transactions,
So it is very
particularly,
difficult to establish.
see, we Indians are not litigious. But anybody outside India is extremely litigious. Press the button, press the arbitration, put you in, and then you are in for a rugmalion. So don't take NDA lightly. Again, as Chinmay Bhai, you said, you're very right. But here, in competition, there are two stages. One is a non-binding term sheet, then there is a binding offer.
Yes.
And then there is a transaction document.
Yes.
So at the binding offer stage, after doing the due diligence, he binds that yes, I am acquiring this company, 51% stake, 76% stake for this enterprise value, this is the equity value, and I bind myself. At that stage, before the definitive agreements, you have to freeze lot of conditions, CPs like condition precedent, condition subsequent, due deal findings. At that time, all the information will have to be revealed, otherwise CPs cannot be finalized, the transaction cannot close.
Yes.
So there is that for one more filter that happens.
Certainly.
Chinmay bhai, for the legal due diligence, there are always advocates as a separate party, but as a financial due diligence, there may be also certain points which needs to be covered by chartered accountant as a legal matters. What could be those points?
So largely, when we talk about our role, it is largely from a financial and tax due diligence perspective. So of course, your direct tax laws, indirect tax laws are definitely something which we have to be well versed with. Apart from that, when we do a financial due diligence, the commercial laws, because a lot of agreements are getting exchanged, right? Relationship with customers is at times guided by agreements, long-term contracts, master service agreements, as one may call it. So there are certain commercial aspects around that as well, which we must be well versed with. Employee-related laws. I think, basic compliances around the Provident Fund, ESI, professional tax, labor laws, Minimum Wages Act, Factories Act. I think these are very, very simpler laws, frankly, and the guidelines also under them are very simple to actually apply and diligence. Unfortunately, not many of us do it, and that is essentially the reason why, only at a due diligence stage, we start realizing that, whether such a particular law or a particular form or a particular filing was supposed to be made, right? So I think apart from, of course, the standard legal due diligence, I think something which we anyways encounter as a part of financial due diligence is the taxation aspects, which we must definitely be aware of. The compliance aspect around the Companies Act, if at all either of the side is a company. There could be LLP as well on one of the sides. So I think those are the aspects which we need to be well versed with. And around the employee compliances, one more step would be around, let's say, if there is a debt funding also happening, and then there are extensive covenants which the lenders will put onto the target. So those are the aspects also, which as a financial advisor or a chartered accountant, we must be aware of that, whether the target has fulfilled those covenants or those financial ratios or certain operational parameters that are applicable, whether they have followed it diligently or not, because if it is not done, then it will actually be deemed to be a default under that particular loan agreement. So I think those legal aspects, largely commercial, from financial, from employee perspective, and from tax perspective, these 4 or 5 aspects we should cover even as a part of the financial due diligence exercise.
Sir,
So if I give couple of examples, just from a financial. So one very major area is a financial due diligence will first look at the historical numbers, 3, 4, 5 years. What is the trend? What are the consumption norms? What is the working capital cycle, etc., etc. Then they would go deep. The due diligence agency would go deep into ensuring that the inventory, whether that inventory valuation looks okay, working capital may receivables, are there any sticky receivables, are there anything which is a problem. Based on that, they will look at the future projections of 2-3 years. My IM would have contained some projections, 2-3 years, 4 years. Then they would try to understand that whether, see, ultimately it's a valuation game, is how much value I will have provided, what is my EBITDA, what is my PAT, what is my sales, what is the sustainability. So working capital adjustment is a very major area. So if I arrive at an enterprise value of say 100 crores, based on an average working capital of say 20, then my term sheet assumption would be that this working capital should be made available. As a part of due diligence, if I find that 2 crores of inventory is sticky, not moving, or 1 crore of receivable is not moving, that working capital adjustment would be made. It will adjust the EV downward to that extent. Similarly, as he explained, Mr. Naik, if there is a non-compliance, now you may feel what is there, but every non-compliance would eventually come, or every litigation. For example, there is an income tax demand. You are disputing. Matter is in appeal. Correct? You are saying, I am very confident. My advisor has said, that you will jaoge. But fellow, that man will say, but no, but what if it goes against you? So you would want to quantify and try to make an adjustment. GST. For example, there was a transitioning from VAT to GST. Many times, many clients have made mistakes. They have not taken input credit properly. फिर वो adjustment आया. There's multiple small things that can enter into, and therefore an enterprise value adjustment between the term sheet and the due deal stage requires a lot of support by people like us or the whole fraternity to help the client in defending his position properly. And those adjustments form the crux of a financial due diligence. फिर मैं बोलूँगा मेरा DCF, मैडम ने DCF calculate किया, yeah, you know, or based on some numbers, and I will say I'm a buyer. I said I don't agree to your numbers because somebody from KPMG, I'm not naming anybody, just giving an example, would say that no, these financial projections are not sustainable. So again, it's an area of dispute. So all these things, it's a very elaborate process which requires a constant support at all levels.
Okay. For one question, I need the input of you all three. That what are the critical due diligence points for the financial and legal which can hamper the entire deal? Promoter says, no, we can't go ahead with those points. What could be those points?
So if I may just start, and maybe of course ma'am and sir can help add on. So like sir rightly mentioned, there are two types of valuation. One, there could be more, but largely in M&A deals, one is your historical EBITDA based multiple. That is one of the method. Another method, of course, is going to be based on your future forecast or the discounted cash flow. When you talk about historical EBITDA based multiple, now I think the most loosely used terms is EBITDA. The way it is reported in financials is not EBITDA. Okay, EBITDA by its definition, again, good and bad part, because it's not defined anywhere, people take it open to interpretation. Frankly, any acquirer would want to take over a target based on its normalized sustainable operating earnings.
Yes.
Right. That is what EBITDA is. Okay, not what is reported in your P&L. You just add back your depreciation and tax out of it. That does not give you, yes, that gives you a starting point of EBITDA. But that is not the EBITDA used for valuation purposes. It has to be sustainable. What do you mean by sustainable? You can't just show 1 year of good profits and start commanding, X times multiples just based on that particular year's EBITDA. It has to be sustainable. Whether a history of that EBITDA is there or not, whether business circumstances have changed which can lead to a change in EBITDA going forward. Then what we call normalized EBITDA is, there are a lot of items sitting as a part of your P&L which could be considered non-operating or one-off or non-operational in nature. Very, very simple example I'll give, and which we regularly face is in terms of interest income, which is generally reported as a part of other income. A lot of times sellers feel that because it's part of my business and because business had some surplus funds and I invested those funds and earned interest out of it, they should ideally be considered as a part of EBITDA. But that is not your sustainable income. You earn that, your business, yes. When can you really consider interest income as a part of your operating income? When your business is into lending or, earning interest out of your funds that you capitalize. So in such cases, the other income aspects or the other operating aspects which are not directly linked to the business, based on which the overall valuation or the overall EBITDA was worked out, and based on which some multiple was offered to you, right? So that is the biggest adjustment that generally comes as a part of due diligence. And I'll tell you why the biggest adjustment. Let's take a case where in the non-binding offer you have been offered a valuation of 8x, 8 times your EBITDA. An impact on expenditure or income, a rupee impact on expenditure or income is going to impact 8 times your multiple.
100%.
Very classic case I'll tell you, in which we across the board say this, a very simple thing about Minimum Wages Act and overtime, which across the board we have seen extensive non-compliances. People don't pay, right? People make...
Gratuity, leave encashment.
Absolutely. But now at least that has improved because of the new accounting standard and the mandatory actuarial valuation. But still, I think something around the labor laws, Factories Act compliance, if you ask someone to pay overtime, you need to pay 2 times the normal wages as overtime. Essentially speaking, most of us I've seen, they make workers work for 12-hour shift, right? But pay only based on 12-hour normal pay. Actually, it has to be 8 hours of normal pay and 4 hours of 2 times pay. So actually, if you make someone work for 12 hours, you actually need to pay 16 hours of pay, of your normal pay. So now in case of such a finding, on a daily basis, you are paying 4 hours less to one worker. Just imagine the size of adjustment which it can catapult into. If you talk about an enterprise which employs thousands of workers, making n number of hours in terms of overtime.
Yes.
So that amount gets adjusted to your reported EBITDA as operating EBITDA, because that is a normalized thing. Because as a buyer, I would definitely not want to default on certain things, right? I mean, just because you would say, the seller may say, this is how I've been running the business, but that does not mean, that's how the business needs to be run. So a number which could come up over here could be running into lakhs, crores, depending upon the magnitude. And the impact on valuation would be 8 times of that number. So that is the most extensive, most difficult, and most, sort of an adjustment which you need to end up justifying. And most of the deals, again, based on my experience, because we have worked extensively on due diligence, most of the deals fail at due diligence stage. The reasons being such expectations not being met, right? Significant valuation adjustments coming in. Then coming to the legality aspects, there could be certain compliances, which someone may just want to override, or someone may have never thought of, but those compliances could have significant penalties. Then in those cases, there could be a holdback, there could be sort of an escrow mechanism, there would be extensive indemnities or guarantees taken from the sellers as well, which the seller may not be comfortable in giving, because those indemnities are not capped, right? For the identified non-compliances, those indemnities are not capped, and it could actually run over and go over the enterprise value altogether.
Yes.
Right? So I think these are those aspects which generally leads to deals going away when certain findings come out of the due diligence exercise. And maybe I'll let Sir.
So Chinmay, I'll give you 2-3 examples taking your clue. Okay. So one, as a part of due diligence, legal. Now, as I said, there are so many laws which even we don't understand. I'll give you an example. We had a client, SME company. The deal was about 100 crores. American company was acquiring. He was already, this client was a distributor of that American company manufacturing similar goods. So America wanted to enter that company. And then they knew each other. So that's how a bilateral deal was structured. Now what happened? He had built up a factory which was not exactly as per the approved plan. Now if you look at any factories anywhere, 90% of the factories would not be as per approved plan. But this American company was a large company. There's no. You have to get it as per approved plan, or you get it rectified or validated. Now, that man, poor fellow, went to the department, and then department said, why are you coming here? He said, sir, ye plan approved. What, are you pagal ho kya? Chale jao. He says, nahi, humko karna hai. So then the only solution was, after 6 months, there was a window available for impact fee. He paid that, and then that transaction went through after 1 year. On this small, stupid reason. For you, 90%, you go to Vatva, Naroda, any industrial area, 90% SME units would have built whatever they want to build without thinking what is the approved. Yes. So this is just similarly, another case. He very rightly mentioned they were working for 12 hours. But mercifully, that client had a good labor law advisor who said that आप अपना जो number of hours का log, you show 8 hours, pay for 12 hours. So on paper, he said, no, I'm not paying overtime. I'm not paying overtime. Where is the question of overtime?
So now as a diligence advisor, where your role really comes in is to understand how many shifts do you run. Now they are saying we run only 2 shifts. How is it possible for a continuous process plan to run 2 shifts with 8 hours? Then where does the balance 8 hour go? Right? So those are the kind of questions which you need to question as a due diligence advisor, right? So the facts are onto the table. You just need to go out of the box and outside of the facts to even question those aspects.
And he said about indemnity cap, correct? I'll give another example. 100 crore, 200 crore ka transaction, EV, correct? Isme, there are some litigations which are ongoing, so ye sab indemnities. So then there would be 2-3 types of indemnities. One is fundamental indemnity. Fundamental indemnity mein koi cap nahi. So it is possible that if that liability can exceed even your deal size, then where will you go? Similarly, there are other types of indemnities, a tax indemnity, a non-compliance indemnity. Har ek mein, their legal advisor would put caps which are unbelievable. 10 times, 5 times, 5 years, the period of indemnity. 5 years. I said, boss, I am selling my company to you. 5 saal baad ab mere paas kya recover karne aaoge? So, these are the practical aspects. Third, one very funny example. Most of these American companies or German companies, they have a policy of anti-corruption. Unfortunately, in India, you can't do a business. Abhi, what is corruption? Koi officer किसी को आया, किसी को 5-10 हजार रुपया दिया, वो चला गया. Now, is this corruption? Most of us will say, nahi boss, it is normal hai. American company said, we don't allow that. You can't do it. He said, so my client asked what to do. I said, you tell him that not possible nahi hai hamare liye. 3 mahina, 4 mahina negotiations happened. We said it is practical. Then you know what is the way out? We appointed a firm, a CA firm. We said that you raise a bill for whatever such expenses you have to incur. And we will pay you. So that was the way out we found out, and ultimately it happened. So these are small issues. You will feel, ye pagal log hai kya? What is it they are breaking their heads on? For you it is most normal, for them it is impossible. And they are so rigid, you cannot imagine. Their rigidity levels are mind-blowing. And therefore you have to find out ways and means to make sure that, and this is after you agreed on valuation, after you agreed on all major CPs, one small thing can delay this transaction. So this is just, I thought I will.
Madam, your view, please.
Yeah, just one example I would like to just bring out, something which is different from the liabilities. It is about the intention of the seller, which has to be assessed as a process of your due diligence. So there was a case where we were doing the diligence, and there was a marketing arrangement which was entered into by the manufacturers of a particular product in that area. And the marketing arrangement did not really specify what is the minimum quantity that will be, sold for each of the participants. And when we had looked at the documents in the related party, they did not, mention a particular name. Eventually, when we were looking at some agreements, we just realized that the signature to that agreement, which was for that marketing, arrangement, was of a person who looked like, or the name sounded very much like a relative. And then we went into it and we realized that there is another entity which is supposedly owned by a relative of the person who's selling this, and the marketing arrangement doesn't specify what is the minimum quantity of this seller which will be taken up. So which means that after the sale, the seller was actually going to really, ensure that there will be more quantity of the, relative who was probably his front that would be sold. So it is something which really went into a forensic kind of an exercise. So, but at the base of everything is whether the profit and the turnover is sustainable or not. And there are umpteen number of examples, the nature of business, the obsolescence factor. Sometimes you go into the product and you realize that this product is really a sunset product. Maybe the seller has projected something, but actually it is something very, very different, His model is not sustainable. All these things can actually be a complete non-starter for the deal to go through.
100%. Just one practical case happened with me recently, just I want to discuss with you, where Big Four was carrying out the due diligence and I was supporting the due diligence. So the company has installed the windmill. Okay, so it was for the captive power, but for the purpose of the tax regulations, separate books of account were maintained. So they didn't agree to take it as a operating income, though it was as a cost benefit. They thought, since you referred that operating and non-operating, so there was huge discussion had that it should be operating income or non-operating income as far as the due diligence and valuations is concerned. So there was a huge discussion happened on that, and what's your view on that?
You would obviously have a PPA, and there would be a willing mechanism,
100%.
and there would be a
Whether
there would be a
will change if
there
it
would
is
be
a
a credit.
captive and
It is-
non-captive.
No, this is 100% operating income. There is no question, because ultimately what you save on your power cost. So then, as an advisor, you say, okay, okay, we'll take the windmill out of the transaction. You're not taking the operating income. I'll take it out of the transaction. मैं रखूंगा मेरे पास, and I will run. Then he will not agree. He will say, नहीं मेरे को चाहिए. So this is very, very classic way of putting pressure. और जितना वो बड़ा बायर है ना, उतना प्रेशर बढ़ता है. और जितना अपना क्लाइंट छोटा है, वो एकदम सफोकेट हो जाता है. 2-3 non-compliances again which came to my mind. One is FEMA. You see, most of the time, our clients don't realize that, say for example, you have a subsidiary company or a JV outside India. So there is an APR requirement which is required to be filed every year. Then there would be an FLA, foreign assets and liabilities का statement. Most of the time, most of the clients would have done an APR, but FLA भूल गए. So in 1 or 2 cases, 3 4 से अगर FLA, तो AD bank does not have any power. You have to go to RBI, get the compounding, get it, क्या है LSF, correct? Late submission fee देके, you have to get that thing corrected. So this would come as a CP. Unless this happens, the deal will not be closed. So these are very few, very clear examples. For example, you have an export business, correct? You have export receivables. RBI का rule है कि 9 months में the payment should come. Many times if it is not, supposing for any reason it is not coming, there could be commercial reasons, inventory piling वहाँ हो गया है, माल बिका नहीं है, distributor के पास, overseas distributor के पास, तो क्या करो? Then you have to approach your AD bank. AD bank is empowered to give a 6 months extension subject to some conditions. Most of the clients would not have complied. So then it would come to you, you would have to help, you'll have to do the requirement. अगर AD बैंक का भी निकल गया और गया तो go to RBI, LSF करो, compounding करो. So all those compliances are a must. And these people, when they acquire a company, we always jokingly say that boss, you have undergone a due diligence and closed the transaction. You are 100% clean, neat and perfect company. इसमें कुछ देखना नहीं. I mean, that is the kind of, it's a very detailed investigational approach on every possible compliance.
100%. Certain time promoters are in very hurriedly to close the transaction and they give the timeline. I want to carry out the due diligence within 1 month, for example. So in that case, our checklist will be different one than the regular.
Not at all. I think the checklist would still be guided by the scope, right? If the scope itself is not extensive, then of course checklist is also not going to be extensive. But you cannot expect a extensive scope to get covered within an unrealistic timeline, because then what you will get is a highly caveated report, which is ultimately not going to help the buyer as well. Right? No one wants to see, okay, fine, like I mentioned, no one wants to see what they already know, right? By way of due diligence, they actually want to see what they don't know, right? So then it does not help, frankly.
Madam, just kindly explain the various valuation methodologies being adopted in case of the M&A.
So of course, nowadays when you look at startups, new age businesses, there is always something like that, turnover multiple and those kinds of things. But very frankly, I would say the best approach that you should look at, means according to me, the best approach is the discounted cash flow approach. Because all these multiples are derivation based on the value that you have based on DCF. So that is, as a buyer and in a commercial deal, the best way to go about is to look at your discounted cash flow. Very detailed exercise should be done there. Of course, there are other approaches like the EBITDA approach where you apply a multiple. Now, how do you derive these multiples? These multiples are also nothing but actually capitalizing your EBITDA in 0 year. That is, you are basically finding out a perpetuity value in 0 year. That's what you are actually doing in an EBITDA capitalization approach. So that is also something that one can look at if you don't have enough data for the target that you are looking at. There could be the PAT-based approach also, which may be relevant in some cases. In some cases, in fact, DCF will not work. Like for example, in case of an NBFC, you just cannot do a DCF. In case of a bank, you just can't do a DCF. What is DCF? Everything, cash is operating for them. There will never be surplus cash. Only dividend payout is your DCF value practically. And who can project dividend? So depending on the target and the nature of business, you will have to select the approach which is right for it.
I think in this this 11 UA amendment, they have suggested 5 new methods.
I would say that one of the approach means I think they are very, very far from really fair value. It is just to satisfy or just basically a tick box. So whatever is the value should not violate the provisions of Income Tax Act, and that is how the proposed amendments it's proposed basically. And it also says that the value at which a PE investor has done a deal, that also becomes a fair value. Then it's a chicken and the egg. Like how can you?
No, it's a comparison, price comparison.
Yes, a comparable transaction multiple is there, but that is a very, very ballpark, number, and that is when the buyer is really he is also playing a game of passing the parcel. If there's a serious investor who wants to run the business, there will always be a DCF which will be done.
There are various regulatory authority are concerned in the transactions. It can be NCLT, income tax, or listed companies, SEBI, stock exchange. So how we balance the valuations for considering all the regulatory authority involved for entire transaction?
Yeah, so when it comes to SEBI, NCLT, so frankly, there is this valuation standards which have come in. It's a good thing to have valuation standards because then nobody can just say that why have you not done something which is absolutely out of your dreams, So at least there are certain approaches which are listed over there. So more or less whatever is the contemporary way of valuation is captured in the valuation standards. Now SEBI has come up with a requirement to disclose the values under the various approaches that you have adopted, and they have a tick box approach also over there. And nowadays the SEBI would insist on also looking at the DCF value being captured in the overall valuation matrix. So SEBI looks at market approach, the earnings based, asset based, DCF. NCLT aligns more or less with SEBI, even if it is not a listed company. In case of NCLT, really, it is a valuation standards which govern because it is under the Companies Act that you are looking at. So valuation standards again revolve around the same approaches, so not very different. You can fit into that, valuation requirement under the standards.
Different valuation professional defined under each act. So how to balance that? Because registered valuer for NCLT, if you go to income tax, merchant banker, so there may be a different value for each valuation.
Yeah, there is a challenge. So under FEMA, it still has chartered accountants and in some cases merchant banker, but chartered accountants, majorly chartered accountants. In case of income tax, it is chartered accountants. In case of that asset minus liabilities and those, which are really not fair valuation. For DCF, for issuance of shares, it is merchant banker. For ESOPs also, it is merchant banker. And so far as the NCLT process goes, it is the registered valuer who has to give the valuation report. In case of SEBI, again, there are many amendments which have recently, last year only come through, and registered valuers are required to give report. Otherwise, earlier to that, there was a requirement to, get a report from a chartered accountant under SEBI. But now that has aligned more with the Companies Act. So being a registered valuer is very, very important if you are in the field of valuation.
So generally, you will have to obtain an RVO, registered valuer, and a merchant banker both. Then only you are satisfying all the requirements. And in case of a listed company, there is also now a fairness opinion, which is compulsorily required by SEBI when there is a listed company getting merged or acquired, etc. Amalgamation I'm talking about, or a demerger. Then a fairness opinion from a merchant banker, Cat 1 merchant banker.
So for the CA professional, there is the ICAI valuation standard 2018, and there is also international valuation standard. So which should be followed?
As per the Companies Act, if you are registered with ICAI RVO, so you are a CA, and if you are registered with ICAI RVO, then you will have to follow the ICAI valuation standards.
Mandatory.
Because under registered valuers rules, you have to follow the valuation standards issued by the registered value organization where you are registered.
Okay. So in case of the merger, for the transferor and transferee company, is it necessary that valuation methodology should be the same? Under which circumstances it could be the different valuation methodology, and how it can be justified?
Yeah, that's a very important question, because ultimately when you are looking at a merger or a demerger or something, then you are looking at a relative valuation. And if you see, it is possible that under different approaches the values could be quite different, but your ratios would be in a particular range under each of these approaches. So it's very important to ensure that you have a balance of approaches. You have to ensure that the valuation methods are the same for both the companies or the businesses that you are valuing. There may be some instance, like for example, if there's one listed player, there's another one which is not a listed company, you will have market price in case of the listed entity, and you'll not have market price in case of unlisted, which is a very, very common thing. Now, if there is there's an example like this, anyway, under the SEBI regulations, ICDR pricing will have to be looked at, and the fair value of the listed company that you are looking at should not be lower than the ICDR pricing. So there are these kinds of mismatches which will keep on cropping up. As a valuer, you should use your judgment. It should not happen that for an unlisted company you use DCF and you use things which will give you the best value, and for the listed company you say that no, projections are not available, so I'm not using DCF. SEBI will throw that report out. SEBI will never approve of that kind of a valuation. So you have to have the public interest in mind. Whenever you are doing valuation in public space, ensure that the public interest is given utmost importance. Everything else, it doesn't matter.
If the shareholding of both the companies is same, whether valuation is required?
Really speaking, no. But there has been I have recently come across some observations from NCLT saying that why are all the valuation approaches not used? But there are also other things which matter here. For example, under the Income Tax Act, there might be some repercussions. If you have not done valuation and you have just done the allotment based on the capital requirement, in that case, there can be certain implications, under the Income Tax Act, and because of that also, it might be a good idea to do a fair valuation, so you don't really get into any trouble.
This mirror will become an internal reorganization exercise in the same shareholding pattern. It may be NCLT would want that, where is that fairness opinion?
Yes,
correct?
Require.
इसमें वो fairness opinion में they just write, they don't go into all these valuation technologies, and they will say that since it is a mirror, this is the exchange ratio, period. They will not apply other methods. So they will need a report which will speak something like this. This is what our practical experiences we have seen.
And in case of the cross-border M&A, who can value?
So when there is a cross-border, ultimately approved cross-border mergers are when the transfer...
Inbound or outbound, whatever.
Yeah. So when the transferee is an Indian company, then only you can do that, because under the Companies Act, you can only do a cross-border where the transferee is an Indian company. Otherwise, if the transferee is a foreign company, transfers an Indian company, it's not going to happen. And since it will go under the provisions of the Companies Act, you will have to have valuation from registered valuer for the purpose of Indian, NCLT. Then it all depends on the other jurisdiction. In most of the in a lot of jurisdictions, you need not really go through court route or anything. It is just a filing, which is required, just a filing. So really, you may not require a valuer there. There are certain jurisdictions which require valuation by, certain people in their who are, operating out of that jurisdiction. That is an exception where you need to really, rope in somebody from there. Otherwise, most of the cases, you need a registered valuer to give the valuation report.
Okay. For the one point, I require the input of you all three. There may be certain identified contingent liability or unidentified. If we say that tax matters, it comes into the board after 2 to 3 years, and there may be issues thereafter. How those are taken care in case of the valuations and due diligence and legal closures everywhere? How those matters are taken care?
So, please go ahead.
So normally when we do a valuation, we always ensure that we take the diligence report. And if this contingent liability is there, we will give a weightage to the contingent liability which is there. And we will, depending on, we might even go for a legal opinion on what is the likelihood of that thing to materialize, and accordingly take a weightage and use it.
How probability is worked out? Because it's a very arbitrary.
I know.
It's a very subjective thing, For example, supposing there is a tax litigation where we are at various stages and we have won, say, up to tribunal, even High Court, we might have won. Then there are multiple years. So depending upon what is the probability, the buyer will take a call. So as Chinmay explained, there could be an escrow mechanism. You may, supposing the transaction value is say 100 crores, we'll say that probability of that liability cropping up could be say up to maximum say 5 crores. So 5 crores can be put in an escrow, and a time limit can be defined say 2 years or 18 months. Within that period, once the liability is crystallized, the escrow will be released. Something like that. Otherwise, many times it is the buyer's call. They have a right to waive any particular condition. A due diligence agency may put 20 conditions. It is ultimately the buyer who has the privilege, the acquirer has a privilege to say, okay, I take a call.
But as a valuer has to put the one figure, no?
No. So, again, as I explained, valuation is so there is one exercise which a valuer has given a value. The second exercise is the discovery of the correct commercial value, which is a matter of a negotiation between buyer and seller. In many cases, the transaction value is first determined, then a valuer is asked, isko valuation karo. Because, see, what I want to pay to you and what you want to receive is my and your decision. We decide that, okay, this is a fair value. Then there will be an income tax compliance, and then there will be a 11U, and then there will be a DCF. तो फिर let's be very frank, DCF को adjust करके लगा देते हैं बराबर. Otherwise it doesn't work. She may say that नहीं value 100 रुपए है, तो buyer बोलता है मैं 80 दूंगा, तो बोला नहीं आपको 100 देना पड़ेगा. वो तो होता ही नहीं है. वो 80 का agree हुआ तो फिर वो 80 पे they will have to work out. I'm sorry, but this is the reality of life.
Yes, 100%.
So I'll just go a step back to your question. I mean, first of all, how do you come to know that there are undisclosed contingent liabilities? Only when you do a detailed due diligence. Right? So, exactly. So I think that is where the scoping of diligence is absolutely very important. To know and to go outside of what is there onto the table, right? That if at all there is something which is not disclosed to you. Now that you will come to know only when you ask questions which are not onto the table, right? So that is around the undisclosed contingent liabilities. So far as disclosed contingent liabilities are concerned, like ma'am rightly pointed out, there are expert opinions to be taken in terms of the output. Typically from a diligence perspective, we put it into 3 buckets: high risk, medium risk, low risk. If it is a high risk, it leads to a valuation adjustment, nothing doing, your valuation has to go down. If it is a medium risk, wherein, like sir mentioned, there are judicial pronouncements for and against both, then it may go into an indemnity or a escrow mechanism. If it is a low risk, it has to be ignored.
Okay.
That's how we would generally cater.
Sanjay bhai, can you highlight certain judicial pronouncement with regard to the valuation exercise being questioned by the various courts? It can be with regard to the valuation methodology. It can be
So,
the
yeah, yeah. So
valuation
I think-
professional.
Yes. So I think you're probably referring to 56 to 7B, there's some recent pronouncements which have come.
Any court,
So I'll
any
tell
court
you- no,
has
no, no,
taken
no.
any view
So
for the
one
valuation
fundamental-
exercise carried out.
So please understand, when there is no dispute, there is no dispute. Neither NCLT nor High Court, Mihir Mafatlal बरसों पहले बता रहे थे कि commercial wisdom courts are not supposed to go into. If I want to buy at a price and you are agreeable to sell at a price, it is a matter of my commercial wisdom. So their courts or NCLT have no business to say that आपने क्यों ये भाव पे खरीदा? No, that's the very clear part. Then there are tax issues.
Yes.
For example, 56 to 7B.
Yes.
DCF किया एक set of assumption के साथ 2 साल बाद वो assessment पे आया. And that the AO would say that boss, whatever DCF estimates आपने जो दिया था वो projection हुआ
Reality and
नहीं.
projections,
हाँ,
yes.
so that means your DCF I'm rejecting and I'm doing an addition. So there are cases where they have done that addition based on the difference between the the DCF and the book value, and then they would say that itna आपका valuation and therefore you become liable. इसमें tribunals, so far if I remember, Madras Tribunal and Bombay, two tribunals have ruled that AO is not supposed to go into the difference between what was the projection based on which DCF is arrived at vis-a-vis what has actually happened.
But if
Because
there is a sea change then?
no. So therefore, what Madam mentioned is so important. You cannot take DCF lightly. You have to make it very realistic, detailed assumptions, which you can justify, defend, based on which, and then if it has not happened, if actuals are much lower, there has to be tangible, plausible reasons why. Say, for example, there is a sea change in the regulatory environment. What can you do? Then, there are some anti-dumping provisions which have come in. Or you are being subjected to something which you could not have comprehended at the time when you made a basic assumption about your business and the cash flows, future maintainable free cash flows, based on which the DCF is worked. Then it is to be defended. So in these cases, even Madras High Court, it has been very clear that you are not supposed to go into if otherwise all other things are accepted. But if it was a completely bombastic and unrealistic assumption based on which your cash flows have been accepted by the valuer and he has done a DCF based on something which is not plausible, then you are at a risk. That is definite. I think these two, three matters are currently going up to the High Court and Supreme Court level. 5-7 साल के बाद मैं आपको बताऊंगा कि exactly क्या है. आज is not possible. But generally, if it is a reasonable, proper, well-documented, well-reasoned valuation report based on which your assumptions and everything is given, which then you should be safe.
One final thought I require from each of you. What are the inherent risk in entire M&A and how you advise the valuation, chartered accountants in the M&A activity, how they should proceed for the M&A activity and how they should have as a other scope of professional services? So one final thought from each of you
So
before
to
we
start
close.
with, I think first of all, as advisors, we must be involved right throughout the process. That is absolutely important. We can't just look at things in silos. That okay, because I am only doing accounting, I'll only focus on getting the data readiness and getting the financial done. I don't care what happens in tax, etc. I think you need to be involved all throughout the process. Right from the commencement of the process, like I mentioned, what is driving the deal? What is the rationale? Why a buyer and seller are coming together, right? So in a very crude manner, if I may just put it, we do a lot of joint ventures. We generally draw a parallel with a marriage. It's like arranging a marriage, frankly. Your NBO happens to be like an engagement and final definitive agreement is like your shadi. Right now, the process between your engagement to marriage, that is where as advisors we need to be there to ensure that, because then just in case of shadi, a lot of rishtedars will come, they'll do background checks, sense check, ladka ye kar raha hai, ladki ye kar rahi hai, etc., those things. That is what we call due diligence, right? So I think as an advisors, our real involvement has to start from the conception, ladka ladki milte hai, at that point of time itself, what is the rationale, right? Why you are getting into it? and to ensure that that actually meets the end in terms of a sustainable marriage, because then of course once the JV happens, deal happens, there is no looking back, right? So I think our involvement right throughout the stage is very important. We need to have a holistic approach. We may not be capable of opining on all the aspects, but certainly I think as a fraternity, someone may be specializing in valuation, someone may be doing in due diligence, someone may be really good in taxation matters, someone may be good in FEMA. I think that is where we can actually work together, collaborate together, right? And I think that's how giving both the sides a holistic view about the transaction and getting involved right throughout the process so that the deal actually goes through in the right sense, the way it was envisaged.
Yeah.
So if I were to just talk about two pitfalls which come to my mind, one is that, see, when you are doing any restructuring, you are looking at the entire business value. It's huge. You know, it may run into a few thousand crores, a few lakh crores. It can be anything. So one has to be very, very careful on the structure, on the tax aspects, because if the structure is wrong, the implications are on the entire value of the business. We have so many cases which are going on and the tax demands run into thousands of crores of rupees. So you have to be very, very careful about the tax consequences of the structure. So it has to be properly structured. No aggressive calls should be taken. It should be always a very conservative way. At least I would always go very, very conservative in structuring, because the implications are immense. And the other thing which is which is to be really taken care of is the business, the commercial side of the business. It should not be that you are looking at something which is a sunset, and the kind of cash flows which are projected or the kind of business value that you're giving now will just evaporate in a year or 2 years or 3 years, you know. So one has to be very careful of what are the developments and whether there is any future or commercial value for this business.
Very quickly, two things I will add. Food is ready. I think most of the people would be hungry and I don't want to take more time. Two aspects. One very important part is whether the deal structure satisfies the objective with which the client is doing the transaction. So if a client says that I want to continue with a minority stake for a long time, the deal structure has to ensure that that objective is met. Second is management of expectations. Our problem is our client, if he is on the sell side, he would want maximization of value. The buyer would want a very reasonable or a lower side of a value. Managing client's expectation and making sure that he talks on a realistic platform is a very important role. And we have to be very transparent, very fair, very open in the entire process. Then only the transaction will close. If you try to act smart, people are smarter than you. So you cannot assume that. And therefore, I think your role is very important for hand-holding to ensure that you take a proper balanced position and the transaction can get completed.
Both the side of the table, there are
Yes.
No.
And I have seen in many transactions, exactly.
Professional.
So in many transactions, if the buyer understands that yes, the seller's advisor is a very reasonable person, lot of communication happens with the advisor and very little with the client. And that is where I think your role becomes very important.
A question from...
I have advised one of the research scientists for his organic pesticide sale. So like what my senior Sanjay told just now, the deal is going on and now the buyer is asking, it is not patented. So buyer is asking me that HK, what steps should we take to, in your opinion, because you are much deep into this. So something like what Sanjay said. So buyer is asking the seller's advisor that when the patent is not there, what extra due diligence needs to be made?
So I think at times, first of all, the patent enforceability in India itself is questionable, to be very frank with you. So even if just to have a tick in the box and if you need to get the patents registered, etc., that can actually be addressed by way of a condition precedent, right? If that is really a significant aspect due to which your deal is really getting stuck, right? Unless, yes, like you rightly mentioned, because it's a research science-based thing and something which has not ever been done in India, research patents are very much enforceable out there in the Western countries, let's say in European countries, in Switzerland, in USA, etc. You can even go ahead with if you want a real legal legitimacy of it, then the IP can go back to the US. It will have to be registered over there, but of course your structure will change in that case, right? Because your IP is now in a company or in an entity outside of India, and accordingly you'll have to restructure. You can make a holding company over here in India, do the transaction either in India, or you can do a transaction through US as well.
So just to add very quickly, we have to ensure whether that product or the process is patentable. If it is patentable, what is the risk of, if it is not patented, what is the risk of it being copied, and then the whole transaction structure can fail. So if patent is compulsory and global patent is also required, I think you don't have a choice, you have to go for it, if it is patentable.
So my question to Sanjay bhai, suppose company wants to acquire any company which is under IBC and lenders are ready to waive partial loan for that target company. How can we save the MAT liability on the target company? Because there is some liability will be written back in the books of target company.
So one is, of course, when it comes to IBC, the valuation game completely changes. It is COC that takes the final call. There would be a haircut, there would be. So again, we are probably referring to Mahindra judgment and so many other cases. Income tax has made a lot of amendments to ensure that whatever is the carry forward losses, to the extent legitimately available, they would be continue to be available, so that the buyer has that certainty of what is the tax that is available. As regards MAT, it is a function of accounting. We will have to see that particular balance sheet, but there are ways and ways. You can do a direct entry and you can eliminate, but ultimately whatever is written back. See what happens after IBC, the company becomes clean, all the liabilities, so you get a very clean balance sheet. So the benefit of getting a clean balance sheet versus some loss somewhere, it's a matter of trade-off. I think you have to study the balance sheet and the reality, and then we'll have to work it out.
Can I just add something here? Okay, so in a lot of cases, what is done is that the debt can be divided into sustainable and unsustainable debt. And so that is just, then the unsustainable debt is transferred at a price, okay, which would obviously show that it is quite unsustainable, but there is no write back then in the books of the company. And in case of sustainable, it will be transferred definitely at a haircut by the lender. But then when it comes to the repayment, in the waterfall, you would have taken that the debt is going to be paid. There is going to be interest which will be paid, because we are looking at EBITDA positive assets. It's not that these companies are bad really. So you will have a lower value because the repayment is going to happen over a very, very long period of time. So one can cut down on how much to write back, depending on how you are going to structure the transfers.
Yeah, but Drushti, I think in my view, in most of the IBC cases, whatever is unsustainable, the resolution applicant will say that I don't want to pay. I don't want to carve it out into unsustainable. For example, in Syntax, the debt was 7,000 crores. The deal went at 3,600 crores. And that's it. Rest all gets written back. That is where perhaps his question becomes relevant. But companies like Reliance have found out ways and means of doing it very effectively.
So I think one thing from MAT perspective, I think there's already an amendment in 115 JB, which gives an exemption to the IBC companies. But your question is very relevant when it talks about section 41.4, when a write back of liability happens. So until now, people used to rely on Mahindra's judgment.
That's what I said.
But now there is a change in section 28 itself. Right. So basically, yes, this will be deemed to be an income in any case. But again, like sir rightly mentioned, see, if this is actually affecting the rationale itself, the buyer will not want to go ahead, they will change the resolution plan altogether. So I am not doing this deal if this value is not onto the table.
Correct.
It's as simple as that.
Namaskar, sir. Sir, there are so many opportunities as we have discussed right now about this valuation and the advisory aspect about due diligence. But are there any liabilities attached to the professionals that we have to consider while taking any assignments? And can that be mitigated by the professional indemnity or not?
So first of all, if you are looking at listed space, then there is this insider trading, which is a very, very important thing one has to look at. You know, it should not happen that anybody does any trading because you have the NDA, non-disclosure agreement that you would have signed with the company, which is just an agreement with the company, but there is also SEBI regulations which are very, very strict, you know, on insider trading. The liability, the penalty would be not very high under SEBI, but of course the stigma to an insider trading will be very, very serious, and of course there will be long-term repercussions on the practice.
Just to add that, actually, I am talking about the liabilities. Those are going to be like from the aspect of the buyer side. Like if someone is buying some acquisitions or acquiring some company, if that deal does not go in the fruitful manner, then can he claim on us that you are doing something wrong in the due diligence report? That's why it has gone wrong.
That cannot be, because ultimately in your due diligence you will write very clearly it is based on the information that is given to you, and you would have applied your mind. Ultimately diligence should be used. The underlying golden rule is that diligence should be used. If you have been very like you have not used your diligence and done in a very shoddy manner, then definitely somebody can say that yes, you not used diligence, but there are never any engagement letters which say that there will be liability on the diligence provider or the valuer or the advisor. At least in India, as of now, I have not seen any such clauses.
They are very
of
strong
liability. At
disclaimers.
least in India, it is on there.
They are very clear disclaimers. No way.
So just to add, from protecting the liability of a buyer, nowadays very novel concept in India, but in Western countries very much followed. There is something called a W&I insurance, which the buyer generally takes. The W&I insurance is basically our warranties and indemnity insurance, which third-party insurance underwriters do give. They take a very serious cognizance of the due diligence report. Anything that has been highlighted in their due diligence report, they will not cover at all, right? Their liability will kick in only when something which was not in the knowledge of the due diligence advisors, neither in the knowledge of the buyer, nor in the knowledge of the seller. And now, of course, what is in the knowledge of what? That is, of course, a separate matter altogether. But yes, there are insurers who are ready to cover a W&I from the perspective of buyer.
Thank you very much. First of all, let us have a big round of applause for all our panelists. So it has been a great panel discussion, I would say, and sometimes we got the feel like some actual simulation is being carried out over here, when Sanjay Bhai was like representing the kind of the buyers or the sellers, and he was dealing with the professionals, other professionals who are the part of the entire this process. So like valuation aspect, due diligence aspects and all this. So we got a lot of experience which actually is there, which they have brought in to us. Drushti Bhai also very rightly said that yes, this valuation is sometimes I would say more of an art than science actually. So 10 different people would be doing the valuation in a very different way, because it's kind of art. And yes, it is actually what the buyers and sellers that want that drives the market, and that is how the valuations are actually being achieved. So very important this thing, and Chinmay Bhai also very rightly said that due diligence aspect are very, very important, and they actually utmost diligently these are to be carried out. Otherwise, some one wrong restructuring can create havoc and can be very catastrophic, I would say. And lastly, the question of this insolvency was raised by Hemang Bhai, and I thought कि जब mergers acquisitions की बात चल रही है तो अभी तक IBC एक बार भी आया क्यों नहीं? Because this is the most important tool these days. IBC is something. Yeah. No, it's okay. Just like in the lighter tone. But IBC is something which has become most important way of doing these transactions these days. Sometimes the things are being planned in such a way that the acquisitions are done through the IBC. So wonderful deliberation from all the panelists. Thank you, and now let us join for the lunch. Thanks a lot. Thank you very much.